Hello everyone, we're here today. I hope we're all having an amazing time. So today we're going to continue our course on terminologies, continuation of terminologies. In forex trading. And I hope we have been following up so far for the previous on the in the previous videos. So the first one I'm going to be talking about today is open order. What's an open order? Is a buy or sell that doesn't expire until it is cancelled? Like now, maybe you place a trade, you place a buy trade, not until it is cancelled. Sorry, not until it is cancelled or sell. It's still an open order. Are you understanding now? So it's just like the same thing as an open position when you are in the market and then you place a trade and then it has not been closed yet. So the open order is like the same thing with open position in the market. So the next thing we are going to be talking about is overbought. This overbought and oversold goes in line. Oversold. Okay, now let's assume that the market, I know that we've not really spoke about support and resistance, but let's assume that the price of a market has been going like this, like this, like this, and then it goes up more than the normal way that it's supposed to go. We regard to it as overbought, and then comes down back, and then again, and then goes down so much, and then so we are going to regard this as overbought. More than the expected value, like the price went high so much, more than what we were expecting in the market. So God is there overbought, or we say it is oversold in the market. So that's what it means. And we actually use this as a strategy as well in forex trading. When we get there, you're going to understand more about how to use that to get yourself some profit. So let's go to partial closure. What's partial closure? Let's assume you place like 5 position now. 1, 2, 3, 4, 5. Regardlessly, I don't know, buy or sell, whichever one. And then your trade has been running to profits. Let's say the market has been going your way, and then you feel like, okay, you can just close this. That's partial closure, and leave this to at almost entry, and then let's keep going, run up. When you close some of the position that you have opened in the market, that is what is called the partial closure. Then let's go to pending order. What is pending order? It's just like a set in the trading platform. When you set okay, let me just give you practical. Okay, practical is just good more than me saying the theory. Okay, let's assume that you feel that this has been coming all the way from uptrend, higher high, lower low, higher high, higher low. Then you feel like the market is going to buy at this particular place, and then you put a pending order of buy. A buying pending order has been here. You predict that the market is going to buy here, right? You've already predicted it that the market is going to buy there. Then what else for you to do is just that wait for the market to get here, Since you already placed the pending order, once the market get there, it's going to take the trade for you immediately. That's like a pending order. It can actually work like a buy pending order or a sell pending order. So let's check the sell pending order. What was the sell pending order saying? What was it talking about? The sell pending order is like this. Okay, sorry. Let's assume that you feel like the market is going to sell at this particular point in time, and then you feel like, okay, I'm just going to put my sell pending order here. Just have to put your sell pending order here. That once the market gets here, it should sell. Like after your analysis has been made and you already know what you're doing in the market. So once it gets there, it's going to actually sell for you, since you already placed a sell pending order there. So it works automatically as well. I hope you understand that. So the next thing we're going to go about is PEEP, which was actually a whole video that I did in one of my previous videos. I talk about PEEP. Now PEEP is the smallest measure of a currency. It is in 100,000 units, any of it, name it. I already did a video about this, but I just talk about, I just want to mention it to let you know that it's one of the terminologies of forex trading as well, which you need to know or get yourself familiarized with. Portfolio is just is your money, the money in your forex account, the money in your forex account. Actually, crypto traders see their portfolio as the coins that they are holding: BTC, FTM, Ethereum, BNB, name it, anything. So portfolio is just like your bag in the forex market. And then profit or loss. Profit is when you win a trade, and then loss is when you lose a trade. So that's how simple as that, as ABC, without wasting any of our time. Program trading is like automated trading. Let me just make it this way. Automated trading. Yes, because it's like when you are using a robot to trade, it's like trading with a robot as well. Trading with robots. Like now, let's assume that you place your robot already, because it's like some inbuilt app. So like some programmers will build it, and then they will suggest it to place trade after some confirmations have been made in the market, and you suggest this to sell. This robotic trading is going to sell for you automatically without you placing the trade yourself. Yes, that is program trading. So because it has some coding that has been made on it to let it function the exact way they want it to function, the exact way they want it. And then we have here code. What is code? Code is an indicative market price used as information only. Like now, like which codes code, okay, like let me say like code currency now. Imagine saying like code currency now. Imagine saying code currency, which you believe to be at the right side, right? So code is like an indicative in the market as well. We use that as an indicative. You might not actually be coming across all these words, but it's actually some things you actually need to know as well. Remember, we have the code currency, the base currency, base and code. Base left, code right. No one is actually going to hack you this in knowing what the forex market is saying, but I believe it's something that you need to know as well, and that's why I'm saying it. Range. What is range? Range. I'll just say ranging. Anyone. Ranging just reverse to like when a price is creating a high and a low within within like some kind of set some kind of price levels. When it's creating high and low in the price levels, without breaking it, like almost just like going within it, going within. I'm going to later create a video that talks about range itself, that talk about support, resistance, and some other, but this is just the theoretical aspect, so I'm not going to show you any example of it. Okay, so imagine this is let's say the price here is 1987, 1986. So the price keep going up, going down, like in that same range of price. That is called what we call range. So, or sometimes we call it sideways market. Let's go about resistance. Resistance. What do we know about resistance? Resistance serves as a ceiling for past or future price change. It is the opposite of support. Okay, let's assume, I will just say resistance is when a price is finding it difficult to break the up like this. Still come back there. The basic principle that we used to, okay, sorry about this, let me just take this away. When there is price rejection at a particular zone or a price, rejection maybe once or twice, if it happens once, twice, 3 times, and 4 times, or anything, and then we have a law for resistance: sell at resistance. We believe that when the market gets to a resistance, it needs to respect that zone to sell. So probably you can just take a sell at a resistance, depending on how your trading analysis has go so far. You can just take a sell at a resistance. It is very easy for you to take a sell at a resistance. Probably just going to check higher time frame. What are the higher time frame, like I spoke in the other video, like 4 hours time frame, 2 hours time frame, to make analysis before you take any trade, or you sell at resistance. So that works that way too. And resistance is the opposite of support, so please get that in mind. There's something called retracement. Retracement is when the market moves back. When it moves back, and let me just bring an example of this. Maybe the market starts from point A to B. We believe that the market needs to at least retrace to the half. Sometimes half, sometimes in a particular percentage. Sometimes it doesn't retrace fully. Sometimes 67%. Sometimes comes back to the point where it has been coming from before, and that is why we use the fib retracement that I taught in the previous video. I can just determine this now. Okay, from point, let me just say point A, from point A, that is here, there is a market retracement. The market has been moving from point A to point B. Market moves to point B right here, and then I'll just name this, say point C. Okay, let's say this is point D right here, and then point E, which is some kind of retracement that happened. Okay, when the market moves from point A to point B, it retraced back to almost maybe I think 80%, because it's 78%, almost 80% or 81% of point A to B. The market retraced back. So we believe that the market is already retraced. And then from point C to point D, the market retraced to almost 50%. That's retracement. You can find it anywhere in the market. When the market is retracing back, the price must always retrace. Price must always retrace in the market. Believe that and know that price must always retrace, and that's why we always have the lower low, the higher high, lower low, higher low, higher high, higher low, higher high, and all of that. Let's check what is risk management. What is risk management? This involves the ability of a trader to reduce their risk. Yes, you must be able to reduce your risk. Let's say you have at least a very small account of $100, and then the proper lot size, at least I think the smallest the broker can ever give to you is this. Yes, maybe the smallest, or actually like maybe this. You must know how to manage your risk. Or maybe a trading is not going your way, the market is not going your way, close it, or it your hair sell, your stop loss. Don't feel bad. Know how to risk. You must be able to know how to risk your money. Risk is one of the most essential thing in the market. And don't forget, what is controlling this market? What is controlling the market is that is greed and fear. These are the two things controlling the market. So imagine now, someone is making money, they want to make more, and then some are actually afraid to enter the market. So it's either greed or fear that's controlling the market. So your risk must be minimal, so you don't lose all your money because you're trying to gain big. You're trying to take $1,000 to $100,000 in 10 days. No, it doesn't work that way. It works with patience. It works with patience. Please. Another one is scalping. 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 This is just a practice of short-term trading. Short-term trading. Short-term. Yes, when you trade in a very short term, you're scalping it. Scalpers. Scalpers are the ones that are scalping. Scalpers. Scalpers are sometimes full-time traders too, because they take opportunities. 10 pips, they're out of the market. They don't waste time at all. They don't want to stay in the market so long. Unlike long-time traders that can trade for a day, 2, 3, 5 days, 1 week, 3 weeks, or swing traders that trade for years, because some do open their position for years, to months, years. So let's go into short position. Short position, like I said, anything short is what? Sell. So there's no need to go over that and that and that and that again and again, because I believe that we already know what it is. Then let's talk about spread. You remember I made mention of this spread that is like a gap as well. It's like a gap as well. You know, just the difference between the bid price and a particular point in time and the price of the market. There's always going to be a space here. Always going to be a space here, which goes to the broker. The price, the actual price goes to the broker, and then I'll talk about spike. What is spike? Let's say you have a support and resistance here. You know, I spoke about resistance already, which is here. Support always under, and then you've already had the market. The market has been doing well. Let me just say the market has been in a zone having, you know, good time, and then once there was just a spike, there was a large, you know, breakout or something. This is a spike, like once it happens, like, you know, massive, very massive, and breaks the zone out of the place. Let's talk about stop loss. Stop loss is an instrumental tool in the market that allows you to stop your loss when your trading is not going your way. Maybe you're actually placing a buy, but it's not actually buying and then selling. And then let's say this is your entry. You enter the trade here. You can just put your SL here. So once it gets here, you are predicting that this market is going to buy, but now it's no more buying, give you little profit, and then reverse back to where you bought, and then hit your LCL. So that means your LCL, which we know as stop loss, because that's the short form SL known as a stop loss, and it hit your SL. So it's just a way of risk management, just for you to risk. And before you go into trading, you must know what you're about to risk. You must know what you're about to lose, how much you're about to gain as well. So that even if you open like 3 positions, you can do partial closure, close some of your previous position that you've opened before. You have a stop loss here. We have your entry here. So, and then it's just to reduce this loss that we can have in the market, because you cannot control the market, but you can control your money in the market. And then we have support, which is going to be the final one I'm going to say here in this video. Support is just a zone in the market where price seems not to break below of it. Yes, remember that we have resistance. Price cannot break up. Price keeps touching that zone again and again. Support, like there is support there, there is something being supported there. That's why you call it support, because price seems not to, like, break below. And then there is a law and a principle that we used to use in forex market, is that buy at support. Only if, because with time you're going to study about support and resistance very well, so you're only going to buy at support only if your analysis and everything that you've think about the market and then you've analyzed in the market tells you to buy at the support. If it's very strong support and it's like maybe on a higher time frame, 1 hour or 30 minutes, so that's still good. Thank you very much for watching, guys. Subscribe, comment, like, share. Love you guys.